it. So our panel today, I'm really delighted. First of all, we're going to start hearing from Alastair Davis, Social Investment Scotland. So Alastair's going to give us set the scene really in terms of social investment tax relief, how it's been used in Scotland and just some observations. Then we're going to hear from Mel. Mel's with Big Society Capital, and obviously for those of you who've been following some of the campaign to save social investment tax relief in the last budget announcements, it comes from UK legislation. So we wanted to give that broader context on this webinar today. And then we always like to bring in people that are actually practitioners. So delighted to be joined by Susan today, who's going to talk of her experience in terms of opportunities and challenge and looking at raising investment in this way. So really delighted to welcome our panel today. And we're going to start off with Alastair. So over to you, and thank you very much.
Well, good morning, everybody. It's good to be with you all today, and I'm grateful to you all for giving up some time to talk a little bit about what I know is perhaps not the most exciting topic in the world, but it is something that does, I believe offers some potential in terms of the future development of the social enterprise landscape in Scotland. And what I really wanted to do before we got into some of the detail, which I know that Mel is going to discuss with you all, is just reflect a little bit upon social investment tax relief and the journey that we have been on to date, specifically in a Scottish context. The first thing really just to highlight is that social investment tax relief is actually not the only tax relief mechanism that is open to the social enterprise sector. And in fact, there is another relief, which is called Community Investment Tax Relief, or CITR, which has actually been in existence for many years. And in fact, Social Investment Scotland is 20 years old this year. And in fact, the very reason, or one of the reasons that the Social Investment Scotland was established is because of the development of this new at the time relief called Community Investment Tax Relief. And what CITR allows is for financial institutions to make investments into accredited institutions to create funds that can then be invested in our case, charities and social enterprises. And as many of you will be aware, or for those of you that have been around the social enterprise sector in Scotland for some time, SIS was founded with investment from a number of investor banks. We now call them our founder banks, who all invested a relatively small amount of capital, £500,000 each, using CITR. And basically what that means is we pay them a relatively small interest rate, but their overall return is compensated by a 5%, an amount of 5% for 5 years. So whatever return we pay them, they can add 5% on through claiming the tax relief. And that helps us keep the cost of capital low and not necessarily having to pass all of that all on to borrowers. But later in the development of the social investment marketplace, we were also benefited with the launch of Social Investment Tax Relief, or SITR. Now, I guess one thing that it's useful to say is that we obviously do have a very supportive policy environment for social enterprises in Scotland. And I guess that's been reinforced just this morning by the publication of a new action plan, a refreshed action plan for social enterprises in Scotland. But we do also have access to some of the initiatives that exist on a UK-wide basis, particularly fiscal mechanisms and tax schemes that are developed by the UK government and then therefore open to all of the nations across the UK. And SITR, like CITR, is one of these reliefs. And really, the movement towards the development of SITR was based on the fact that there was an anomaly that had emerged, in that if you were a private business that was just being set up purely for private gain, you could access EIS, the Enterprise Investment Scheme, and raise investment from individuals, risk capital from individuals, to support the early stage journey of your business. But that was not reflected for social enterprises. So there was a movement led by Big Society Capital and others, also reflecting the growing movement and growing interest from individual investors to make investments in this emerging sector, to develop a tax relief that would support the channeling of investment from individuals into charities and social enterprises. Now, that emulation of EIS has created its own challenges, and I know that's something that Susan will touch on a bit later, but essentially the legislation is a lift and drop from the EIS scheme. In the context of Social Investment Scotland, we have used social investment tax relief on 2 occasions as part of a fund structure. We were one of the very first, if not the first, organisation in the UK to raise a fund using social investment tax relief. That was called our Community Capital Fund, which is actually now coming towards the end of its life. In fact, that was recognised with an award from the Cabinet Office. But more recently, our SIS Ventures arm has also used an element of social investment tax relief to raise funds from individual investors to give organisations that are eligible for SITR access to that particular relief. However, it's not perhaps been, well, we know it's not been as popular as the UK government had expected, and I know that that's something that Mel will touch on based on the reflections from the most recent campaign to save SITR. One of the things that's often mentioned in the context of SITR in terms of the benefits that it brings is that it's, in theory, should allow social enterprises access to cheaper sources of capital through relationships with individual investors than that might be raised from intermediaries like Social Investment Scotland. And to a certain extent, that is true. It is up to, if you're raising investment direct from individuals and not through a fund structure, then it is up to you to negotiate the terms of that investment with those individual investors. Now, where this does work particularly well is where social enterprises might already have access to a network of individuals, perhaps from the local community, that might already be used to making tax efficient investments. And if you already have the route to those investors, then the process of raising investment can be a lot more straightforward. Where I think some organisations have struggled is that where they've expected this to be almost the solution to all issues related to social investment, and they've tried to raise investment using social investment tax relief, and it's proven to be much more difficult than what they had expected. And therefore, it's taken a much longer time than what they had expected. And therefore, if you were to look at the cost overall, in terms of the management time involved in raising capital using SITR, then it might not actually in reality be less than raising investment from the mainstream social investment marketplace. I think now there is a real challenge for us all to recognise in terms of the future of SITR. There has been the campaign, it has been saved. Scotland has traditionally punched above its weight in terms of having access to SITR. That's not only through funds like those that have been launched by SIS, but also through initiatives like Launch Me at First Port. And I think the data does show that on a per capita basis, Scotland has raised more funds using SITR than other parts of the UK. But there really is a challenge now for us all to really take advantage of the benefits of this relief, despite the restrictions. Otherwise, there is a real risk that we will lose it forever. And I think that one of the things that I'm keen to understand a bit more of, particularly from the discussion today or from the questions, is if there is indeed a role for an agency like Social Investment Scotland to providing information, advice, and perhaps support to organisations in terms of how they can actually use social investment tax relief in reality to raise capital to support their ambitions. So that's really all I wanted to say at the moment to set the scene. And I think I pass back to Naomi now.
You do. Thank you, Alastair. I've been making notes as you speak, so we're always ready to come in with questions at the end as well. Mel, we're going to hand over to you next in terms of giving us that broader context, I guess, from a UK perspective, and then we'll come in with Susan. Over to you, Mel.
Lovely. Thank you very much. Thank you, Alastair. That was a great lead-in. Excuse me. I'm going to actually use a few slides. I prefer to talk usually, but because we are talking about tax and Alastair's already done the piece by saying it's not always the most engaging subject, I thought it would probably help to keep you with me, but I'm going to try and give you some context around the subject as well. So hopefully you can see that. I'm really going to talk about what comes next, because Alastair's framed, I think, some of the challenges, and I'm also just going to give you a little bit more detail, and it's going to be very light touch because, as Alastair said, this is a little bit complicated in places, and try and simplify it so for ease of understanding today. So let's just go and talk again about why we need SITR. So the whole purpose of it being designed was around enabling, and I've put social enterprises in brackets because actually there's some restriction about who can use it, but essentially to raise investment and then to offer their investors a tax relief. So all tax reliefs are introduced by Treasury to incentivize investors to take risk. And certainly social investment tax relief was to try and bring new investors in to take more risk and to invest into social enterprises and charities. And essentially the reason behind that was it was designed to help fill a funding gap for social enterprises. So we often talk, and there's lots of UK-wide research that will say that what social enterprises and charities really want is patient and affordable risk-bearing capital. So, you know, Alastair talked about some of the ways that the tax relief is used to potentially be able to bring down the cost of borrowing, particularly for smaller amounts or for things where there perhaps isn't so any history in the trading. So let's just do a little bit about how SITR works. Well, I'm going to start off on the left-hand side and say that social investment tax relief doesn't unfortunately work for all organisations. So you currently have to be a charity, a community interest company limited by share or by guarantee, or a community benefit society. And then there's one other type of organisation. So they're accredited social impact contractors, and they're a special type of governance structure that is authorised again by the UK government for provision of social impact bonds. So probably the least used or least well known. So I tend to concentrate on charities, KICs and BENCOMs. So just 4 things, and it isn't as simple as this, but the 4 things that I like to make sure people take away is that this is tax relief for individuals. So when Alastair was talking about community investment tax relief, that's enables organisations to make investments. This is a tax relief. SITR is a tax relief for individuals. So that's a real person who has to invest money into a social enterprise. And one of the unique facets of SITR is that it can be done either in shares or debt. So although, as Alastair said, that this is a direct lift from other tax reliefs like EIS, Enterprise Investment Scheme, many social enterprises and charities were unable to take advantage of those types of tax relief because we're often not able to give away shares. And so SITR enables raising investment in either way. The tax relief allows for the individual investing money to claim 30% tax relief on the amount invested. So simply put, if an individual wants to invest £100 into a social enterprise and it's a qualifying social enterprise, then essentially they're able to claim £30 back of that money as tax relief from HMRC, which essentially means that only £70 of their capital, or the investor might see that only £70 of their capital is at risk because they've had that 30% back. The other condition is that a social enterprise uses the investment to fund trading activity. So, you know, this is a tax relief that is aimed at helping organisations to grow and scale sustainable trading activity. And the other thing, I said it needs to be, you know, we want patient and affordable capital. So there is a criteria that says that when you borrow money using social investment tax relief, the principal sum that you borrow, so the capital, can't be repaid for a minimum of 3 years and a day before it can be repaid or sold if it's shares. I would also say that it doesn't have to just be 3 years, and often SITR deals are structured over longer than that, but that's certainly the minimum amount of time. So how SITR has been used, yeah, Alastair's right. It's really difficult actually when you're trying to talk to Treasury, as I do sometimes have occasion to try and work out what success actually looks like and what do we think successes. It took a very long time for the EIS market to get moving, and there's obviously many more organisations that are able to use the Enterprise Investment Scheme than are able to use social investment tax relief. But currently it stands at about £15 million worth of investment. It's we've got 92 deals registered, but I've just come across some more, so I think it's about 100 organisations that have used SITR. By number, 46% of those deals are in community shares. It's certainly a key way that communities help their communities to be able to invest into shares. And there's some evidence that shows that if you're able to offer social investment tax relief, that it actually increases the average amount that each investor feels that they can invest in community shares. But with this being one of the unique facets of SITR, it's probably unsurprising that actually the largest amount, so 53% of investments gone via debt or loans. And it's actually not unusual for community benefit societies to raise SITR investment in both ways. In fact, there's some good examples like a community cinema in Shropshire that's both raised SITR on community shares, but also on a loan. And as Alastair said, Scotland has been great, has used SITR as about 18% of the deals, and that will be certainly influenced by the accessibility of the capital through Social Investment Scotland, but also, as Alastair said, through Launch Me at First Port. There's also been a fair number of direct deals, but it is one of the reasons that we fought so hard to save SITR is that the UK government talks a lot about the levelling up agenda and investing into communities and bringing along left behind places. Well, SITR is used all around the country. In fact, it's probably one of the few forms of social investment that is not concentrated in London and the South East. So there's a very high proportion of deals that happened in the Southwest, as we said, in Scotland, into the Northwest. So this is a tax relief that definitely works outside of the normal parameters. So, it's been really interesting being involved with the campaign. We spent a lot of time, as Alastair said, working with partners to get this tax relief introduced. And I've spent a lot of time with Get SITR, trying to encourage people to understand how to use SITR. Can be a bit fiddly. There are quite a lot of rules and regulations that go around it. But we were really encouraged when in the budget we were advised that there would be an extension for 2 years. I mean, essentially, why would you lose any tool as part of our efforts to build back the economy? Why would you take something away? And I know that we've got organisations, there's a community arts organisation that spent 4 years putting together its investment raise, and they're delighted that this is not going to fall away now, so they're currently able to continue. But it was never really about just saving SITR, echoing what Alastair said again. It's always really about it been extending and expanding. And one of the real key challenges we have is that 2 years is really not long enough. Probably doesn't take me to say this. I'm sure, again, Alastair would say that it takes more than 2 years to raise money, particularly if you're going to do it via a fund structure, get a pipeline going and then get it deployed. So one of the first actions that we're taking is to try and see whether we can say thank you very much to Treasury, but actually 2 years isn't long enough, and can we have at least 5 so that we can really try and unlock the potential that SITR has. Beyond that, we spent a lot of time at the consultation, which the information on that was actually published finally yesterday, lobbying government to expand the trading activity. So there is a lot of lots of things that you can do, and then we have what one of our legal eagles replies to as the naughty list of things that you can't currently do using SITR, and we would really like to see that expanded. The 3 areas that came out very strongly through the consultation were the expansion of community energy, which was originally not included because there were other tax reliefs which now don't exist. We obviously have, and this has been compounded by the pandemic, a real health and social care crisis, and care homes could be one of the areas around property where social investment tax relief could be used. But one of the real problems was when the tax relief was revised, licensing and leasing was removed, and that's really affected the way that community hubs, pubs, shops put together their business cases to be able to raise money, and particularly those using social investment tax relief, particularly because EIS has now been ruled out for them. And they're not able to use that. So one of the things that we're doing at the moment is we're trying to gather some really quick information on organisations who might be able to use SITR, particularly around trying to lobby HMT before the extension hits the statute books to see if we can get that 2 years moved. I've put a link on there to our website, which is focused just on SITR, and we share lots of useful resources and templates to try and simplify it. If you have a couple of minutes, and perhaps I'll get Duncan to circulate this afterwards, it would be great if you could just fill in the survey so that we can try and take this information to government. So I'm probably going to end there by saying it's great that we've got it. It's not enough, and we need to do more, and we really need your help to do that. And I know Susan's going to probably talk about, just one of the ways that if SITR was available, might be able to help organisations like hers.
Thank you, Mel. And I guess without holding back any further, I'm delighted to bring Susan in terms of, I always think it's really important to understand this from a practitioner point of view, as well as support agency and intermediary point of view. So delighted to welcome Susan for her perspectives on this too. Over to you.
Good morning, everyone, and thank you to Duncan and Naomi for inviting me. I have to say that I'm delighted in one respect that Homes for Good and I am officially on the naughty list for SITR, although we would like to be able to access it because, yeah, I quite like being on the naughty list, as many people know. Seriously though, I think what Duncan, when Duncan asked me to speak, I did say that we've not been able to access SITR because property was an exclusion, or is an exclusion, and we explored, as we do with any new investment that comes up, we look at what we can, how it's applicable to us, and it clearly wasn't applicable to us. And actually, my recollection of the way that the SITR evolved was that it was almost just a sort of, putting EIS through a social filter, and property was excluded from EIS. And that then meant that property was just automatically excluded from SITR. And I think that, that's a big mistake, and a big missed opportunity for all of us that are involved in either buying assets for our own organisations or from a social housing perspective and the critical social housing need that there is. If we were able to access SITR with investors, we would be able to raise, decent sums of money to then match and do more work around that. So that's something that I hope will change. But Duncan had asked me, given that we've not got direct experience of SITR, just to talk a wee bit more generally about my experience of raising different types of social investment per se, to grow Homes for Good. And I think, we have used all sorts of social investment throughout the time of Homes for Good growing. And, starting at the beginning, in the first few months of Homes for Good, I accessed loan finance from Resilient, from the Start and Grow Fund, I think it was called. And that was a mix of, that was blended capital, and where I had the mix of grant funding and loan funding. And that was a brilliant product because there was what I call free money alongside the borrowed money. And I used that initially for working capital. And that's often the first thing that is, it's the thing you need to get started when you're starting a social enterprise. And the one thing I would say about that is that it is great when the money lands in your bank account and you've borrowed the money and it looks like, you've got the repayment profile over 3 years or 5 years or 10 years. But from a trading perspective, you need to be as confident. You need to really think carefully about when you've spent that money, when you've spent that initial money on the working capital, the working capital that you've got, how is it going to feel in month 37 or month 38 when you've got that repayment? And actually, there's a couple of my colleagues that were in, I was also very involved in First Port. I took Homes for Good through the Launch Me programme. and we did raise investment actually through LaunchMe, but it wasn't with SITR. And I remember a couple of my colleagues there, we all could remember the monthly payment of that initial working capital loan that we got. And we all, I remember people, you know, talking to me and saying, that's the last month paid off. So I think when you take investment for working capital as a social business, just think carefully that once you've spent the money, you've still got the repayments to deal with for years to come. And then the second area around, you know, where you might use social investment is for growth and for business development. And that is, you know, for me, that feels slightly riskier. And that's maybe where the idea of something like SITR would help alleviate the risk for an investor and hopefully have a corresponding potentially lower cost of capital for the social enterprise, because you have to try and be confident about whether that maybe you're investing in a new product or a new service, or, you know, just going into a new area of delivery, a geographical area. Your sort of assumptions around how confident you are that you can generate that business are really quite important, because it's the new business that you generate and the profits from that are going to actually then repay the debt at some point in the future. And I think the thing around patient capital, which probably sounds like quite a basic thing to say, is that no matter how patient it is, it does need to be paid back. And as social businesses and social enterprises, we need to take those obligations super seriously. That although the investor might be really bought into the business, and it could be quite an appealing interest rate, quite a low interest rate, they are expecting their money back, and we should be expecting to absolutely pay that money back. So there's just something around whenever you're taking on working capital or funds for growth, is, you know, having confidence in your modelling and your assumptions, and keeping an eye on how affordable it is to be able to pay that back. And, you know, through our time, I took on, you know, sort of a traditional social investment type blended debt and grant for working capital. I also had an angel investor that came in during my phase with LaunchMe, and we weren't able to access SITR, but it was at quite a low interest rate, and we were able to then, you know, in the end, pay that back. So we have used social investment for those for working capital in a couple of ways. But the big way that Homes for Good has used social investment is to buy assets. And over the last 7 years, we have raised probably in the region of about £17 million. And that has been from a number of social investment partners, including Big Society Capital, Big Issue Invest, have become a recent shareholder, Charity Bank, and Social and Sustainable Capital. And that has been really straightforward for us, because the business model means that you borrow the money, you buy assets, and the assets generate the income that delivers your core business and your social impact, but also repays the investment. And that is probably, and I think in the review of social investment, Melanie and Alastair will know the figure, but, you know, I'm sure it's close to 90%, maybe 85 to 90% of social investments that are made are secured against assets. It's a natural bedfellow, you know, investment and assets. And I think for me, that's why I think it's important that we challenge government on the exclusion of assets, you know, from an eligibility point of view for SITR, because I think it would just open up, it sort of de-risks it a little bit more for the investor, but it opens up a huge amount of opportunity for social enterprises as well. So that's really all I've got to say on that. I'm not particularly knowledgeable about the ins and outs of SITR. The one thing I would maybe say is that, you know, I haven't looked at it from a Homes for Good perspective in a huge amount of detail for the very reasons that I've said, but the take up is quite low. If it's 100 organisations over the UK, that is quite low take up. So there is clearly a really interesting opportunity for lots of social businesses, and the average investment being about 150k, it's in that lower range that you know, that social enterprises might be able to access. So I suppose my plea or just ideas, you know, and Alastair was talking about, is that should there be an agency that specialises in this? I think the short answer for me is probably, because it is difficult to navigate. So if somebody is available to spell it out to social enterprises about what each step of it means, both at the point of investment and at the point of refinancing, that might mean that many more people are able to access SITR.
Thank you, Susan. That was a really, I think, valuable input in terms of understanding why it hasn't been possible, and interesting, the notes that you said about the kind of 90% secured against assets, and understanding therefore why is it that I guess property is still seen on this kind of naughty list seems odd to me. I'm going to invite our other panelists back on in terms of Q&A. And I can see there's a couple of questions. Well, there's one more complex question that's gone into the Q&A, and I'm wondering whether people have had the chance to read that rather than me read it out, and I'll come to that in a minute. But I just wanted to focus on this point about limited take-up to some degree first. So, as I'm listening, I'm thinking, is the limited take-up because it's quite complex? Is it because there's a lack of understanding? And I think those of us who've worked in and around the sector for some time, I think there's a very varied expertise in terms of financial understanding within our sector. I think that would be fair to say in terms of the more commercial side. Or is it simply that people don't know about it so much? And that comes back to the point of, I guess, Alastair's question in terms of, do we need someone to really focus and offer support on that? And I guess Susan's response, is it simply that without the focused support, there's not been anyone kind of really showing it as an option? So I was going to perhaps ask Alastair for his initial reflections just on that, in terms of what is it that we need to do in our sector to, I guess, hopefully increase the take up over the next 2 years, because we're not going to save it unless we can show it's making a difference.
Yeah, thanks, Naomi. I think that one of the reasons there perhaps has been a lower take up is that it's one of a number of options that are open to organisations in terms of raising investment. And at the end of the day, if you are looking for £50,000 for working capital, then there have been a range of other routes that have been open to social enterprises in Scotland. And that, I'm not just talking about money from SIS, that's been from Brazilian or Passport programmes or other social investors that perhaps give you access to that capital. And then you're only dealing with one organisation, one set of due diligence, one set of documentation that's perhaps easier to understand. And then you get your money in the bank, and you can carry on with what it is that you know what to do best, which is running your social enterprise and not dealing with social investors. So I would say that that's one reason. I would say that one of the big flurry, there was quite a big flurry around about SITR when it was launched. It was perhaps positioned as being a solution to some of the issues that had emerged within the social investment marketplace. And I think that was proven not to be the case. It is one of a number of things. And I think what organisations need to consider, a bit like what Susan was alluding to, is the right capital from the right place at the right time for the right thing in your journey as a social enterprise, in terms of what it is that you're looking to do. And I think that as part of that mix, then social investment tax relief undoubtedly does play a role, particularly for earlier stage, higher risk proposals at an early stage of their development. So I think that's probably one point of reflection. I think the other thing is actually getting, as I touched on a little bit, is actually getting access to the individual investors. Most of the ways in which that's happened to date has been facilitated introductions through programmes like Launch Me, albeit not all of that money was raised using SITR, or funds like SIS Community Capital and SIS Ventures. But we know at SIS, it's hard to raise money from individuals. It takes time. And if you're trying to, but that's what we do as a social investment intermediary. But if you're trying to do that perhaps off the side of your desk, alongside running a social enterprise, particularly if it's a smaller, earlier stage organisation, then that can take up a lot of time. And I know from talking to Susan, as we do, that for her, raising investment takes up a lot of time, and it's not all that she's there to do. So I think what we need to do is just a good outcome of today and the relaunch and the extension would be to make sure that this is pushed up the agenda. People know it's a tool but also know where to go to get help and support if it is something that they are at least considering accessing and can go into with their eyes wide open. But there's an opportunity here that we need to grasp. We don't want to lose it.
No, thank you, Alastair. I think pushing it up the agenda, to me, it's been something that doesn't get raised and talked about very often. And I guess, you know, again, I think we said at this, we've seen lower numbers in terms of take up for this webinar than we have many others. And yet we've always got a sector asking about raising finance. So it's quite interesting to me that is it because people simply even don't recognise what it is or don't understand how it can work for them? Or I wonder, and I might come back to this, is there something more fundamental that people don't like the sense of individuals gaining financially from it that is an uncomfortable fit for some of our sector that I think is probably a contentious point to bring up, but I think, is that one of the barriers? I don't know. I think we all share similar perspectives on what we might think around that, but I do wonder whether that's a barrier for some. Mel, any just thoughts and observations, and then I'll just bring Susan in.
Yeah, I mean, that question is, you know, it is a huge one. I mean, I've worked at Big Society Capital for 6 years, and it's probably important to say that, you know, I'm not an investor. So, you know, I ran my own social enterprise before I came to work here. And, you know, 6 years ago, it was very difficult questions. I've stood in front of quite a lot of challenging audiences over the years. But, you know, Good Finance, which I'm also responsible for, has just had its 200,000th unique user. And I didn't know whether we'd ever get to that level. And so, you know, what I think is happening is more and more organisations, even through the pandemic, are looking at, there's more and more need for their services. There's less and less grant. You know, what is the full range of options available to them? So I think that, and then it's also important to say that, you know, things that Susan was saying really resonated. You know, this is money you've got to pay back with interest, you know, and for many organisations, it might not be the right thing to do. But, you know, I've been particularly encouraged, really, that I thought during the pandemic, you know, would this really drop even further down the agenda? But I've not seen that at all. And in fact, I know that some of the our portfolio of investors are still saying to us, you know, that there is plenty of appetite out there because, you know, the pandemic has not affected all organisations equally. What I would say about social investment tax relief is, well, first of all, it's hardly the most snappy name, is it? You know, I mean, to be honest, when I first joined Big Society Capital, somebody said, do you want to go to a meeting about tax? I think I just didn't move out the way quickly enough because, you know, I never dreamed that I would need to know this much about it. And I think it's a bit of a misnomer as well. People tend to think that the tax relief is, you know, for the social enterprise or charity, and of course it's not, it's for the investor. It's also important to say, as Alastair did, that when SITR was first imagined and introduced, there were less other options. Actually, if I'm honest, I think Scotland, you know, does have a more supportive policy environment, and there is a better range of support than there is south of the border. So it was probably even more stark, actually, in England. You know, the nations have had more proactive and more progressive programs, and it was really tough. You know, the average amount of investment for a first-time investee is about £50,000, and you know, SITR certainly was hoping to be able to do something with that. It is complex, and one of the things that we have done, so you know, I'm always happy to work with anybody. We have a website, a microsite dedicated to SITR. Every time we've learned something, we have posted free resources. So if you want to make an advanced assurance application, we now have editable templates. There's no need to go and, you know, pay separately again for that. If we have any piece of technical sort of case law that we've had to test with HMRC, if we find that there is an option, like there's a great one now around a parent charity having to take on the actual SITR investment and then pass it on, and we found some ways that might help the charitable parent company board be comfortable with that, we will just publish it. I do agree that not enough people know about it, and that's definitely something that I spend a lot of my time, and it will be absolutely fundamental to what happens next. But if I honestly had to tell you the main reason, it's because there are too many things on the naughty list that work for our sector. As you know, Susan said, you know, if the whole purpose of SITR is being restricted to asset organisations, which it is at the moment in KICS charities and community benefit societies, then provided that the services, the trading activity isn't immoral or illegal, I don't really understand why stuff is off the table. And if we're ever going to make it a success in terms of size of investments raised, which is really important, not so much for the individual underlying organisations, but definitely for any fund manager who wants to raise a fund, because having the variety in the pipeline for investors to invest into, then there has to be bigger ticket deals out there. And if we were to get community energy, care homes as a first start property, I mean, I'd love to be able to test the property thing. And Susan's right, it is a hangover from EIS, which is, you know, it's seen as being less risky because there's an asset there and you can't secure an asset using SITR. And I'd really like to get the licensing and leasing piece revoked. I mean, that really dented the market confidence, because actually in the first iteration of SITR, there were organisations like South Bristol Sports Centre who, you know, raised quite a big amount of money. Some of it was using SITR, and they no longer are eligible. You know, it's hard enough to make your business model work, as Susan said, you know, in our sector where we're trying to get where there's market failure. So why should it be that the very bits that might actually help to make your business model work aren't applicable to SITR? We will be banging the drum for that, any kind of evidence support, but any way that we can try and work together so that more people know about SITR and can use it, I think is essential.
No, thank you, Mel. I kind of feel like I'm listening with Social Enterprise Scotland ears as well, in terms of raising that profile from a policy perspective as well, and making sure that we kind of keep that banging the drum from a number of people. Susan, I just wanted to come to you. You talk quite a bit in terms of obviously debt finance being quite a challenge in terms of the social enterprise. And I know we're focused today on social investment tax relief, but I just wonder, what would be your much broader plea in terms of where do you think the real gaps are in investment finance into social enterprises that go beyond what's currently, we've talked about there being a massive range, but we know there's still massive gaps in terms of different ways of raising investment. And I'm hearing more and more of organisations that are developing quite complex legal structures simply to enable them to raise finance in innovative ways. So what would be your much broader plea in terms of raising finance in effect for social impact, because that's what we're all about?
Well, there's two things I'm going to say to that, and I wanted to just come back to just some reflections on SITR and how we can increase take up of that. But to your question just now, the first thing I would say is that actually I think there's a fairly wide range of social investment products available anyway. And, you know, if I think about starting, so, you know, social investment became a thing with Future Builders probably around about 2007, 2008. And so when I was at Impact Arts, you know, I was looking at the early stages of social investment, and we took our first social investment from the fund from Social Investment Scotland, whatever it was called, Scottish Investment Fund or something. And then when I started Homes for Good, I was starting as a startup with not even a bank account, me and a logo, going through the first port, getting the £4,000 startup grant. And I think the ecosystem that we now have, certainly in Scotland, I mean, it might be a bit more fragmented in England just because of the size, but in Scotland, we have a superb investment ecosystem. And I think that there's, you know, I don't agree that there isn't a wide enough range of products. I just think there is. I think it's more about the limiting behaviours of social enterprises sometimes is the challenge, and the risk aversion. The thing I would say though is that I am, as you would expect me to say, I am completely committed to the loosening up of criteria around asset lock and around the types of organisations, because what I've always said, and I think it's pretty reflected now in CIS Ventures and the work that, you know, I'm involved in CIS Ventures, is its impact and intent. And the asset lock is, you know, and the asset lock for me is a red herring. You get asset locked organisations that don't deliver impact and whose intentions are not good. And you get private businesses that deliver tons of impact and their intentions are good. and vice versa. So I would say a sort of loosening up of restrictions around whatever form of investment exists. But I'm not sure that there is a gap, because I see that you can access loans from a very small amount. So SIS talks about the minimum loan being about 10,000 or something, right through to 1 million. And, you know, if I've got a plea, it's like, can we have bigger amounts of money at a time? Because I need a lot of money for houses, but that's that old chestnut will never go away. Just going back to SITR, and I was just reflecting on the access to investors point that Alastair brought up, and thinking about what happened with LaunchMe. And I was in the first cohort of LaunchMe, where the deal was that you get some grant funding that matches whatever you can raise from an investor. Now, and I went through the sessions where we matched up investors, and you know, you had to go and present and pitch to the investors. Now, I was really lucky because I got an investor, not despite LaunchMe, but I had an angel investor who came in with £100,000, and it was one of these sort of, you know, she took a quick look and she knew about me and she knew about Homes for Good and said, I believe in you, I'm going to invest in you. So it was actually a very, very, very quick process. But what I think there is, I think there's a missed opportunity, because by the time you get somebody who's willing to invest and a 30% tax relief is important to them, I would say that they're fairly, I'm not going to use the word sophisticated because I know that there are sort of FCA regulations for that, but that's going to be a fairly experienced professional with a level of skills and a level of financial acumen that goes along with the investment. And so so I'm thinking about my angel investor, and what she brought much more to me than the money. She was my mentor for a number of years until she sadly died. And I had access to this sounding board who had a vested interest in my success. She wanted Homes for Good to be successful because she believed in the business, but her money was in it as well. And it was actually, it was symbiotic and it was brilliant. So I had access to a person that I wouldn't have otherwise had, an individual. So these individuals that are getting the 30% tax relief, what is all the talent that they can bring into the social investment and the social enterprise world that we're not getting if we're not, you know, as individual social enterprises, if we're not taking this opportunity. But the other side of that is the responsibility that we have as social enterprises to step up to the challenge. And I know, Melanie, you're saying that it's really quite complicated and that, you know, it's brilliant that every time that you learn something new, it's on a website. We have a responsibility to step up at the plate and be ready for the investment. And I know that some of the SITR investments that have failed are because one of the reasons will be the lack of capacity of the entrepreneur, or the lack of capacity of the social enterprise to understand their finances and understand all the implications. So that may be quite a controversial thing to say, but I think that actually, if we have that marriage, so just go back to Alastair's point about the agency or the specialist dedicated support that really, first of all, you know, doesn't, you know, that matches up the right sort of social enterprise that's ready. And early stage higher risk is completely fine if the quality of the business and the entrepreneur is there. That's completely right. And I think we've seen that in SIS Ventures, haven't we, Alastair, in terms of it doesn't, you know, and maybe Sitter is not appropriate for a more established charity that's a bit more on the, you know, the more traditional end of the social enterprise spectrum, but there will be tons of new entrepreneurs. There's a new generation of entrepreneurs coming through who want to do social, you know, to create social impact. And imagine, you know, if we build their capacity to be able to access it, and, you know, so that they're not thinking, you know, what we don't want is to encourage investors who then say there isn't a quality of pipeline to invest in. Both need to be lifted at the same time. So it's a big opportunity.
Yeah, there's lots of really interesting points. Again, I've been writing down, risk is always really interesting to me, because whenever we talk about risk, we often talk about the risk from the investor perspective, and we don't talk about social enterprises understanding risk. I think we do it in a slightly different way. And before I come in kind of with final questions, this is probably quite a controversial question, so feel free to avoid an answer should you wish. But I wonder, as you were speaking, you were kind of talking about kind of whether our sector's risk averse and whether we're perhaps to some degree ambitious enough. And I just wonder whether sometimes does the sense that the sector can sometimes perhaps appear quite vitriolic in terms of its view on kind of finance and trading and how that balances with communities. Do we actually put people off at an early stage that have got great social impact ideas that could make a massive difference, but almost come through our doors and then kind of go, I'm not sure they're the right bunch for me, and they end up setting up a private business? And I just wonder whether there's something about that we lose a few of those kind of very ambitious social entrepreneurs that go down a mainstream route because we can put them off sometimes.
Well, I suppose the first thing is I'm never one to duck a controversial question. That would be remiss of me. I don't actually care. You know, I think if the social enterprise sector is putting people off, and I don't know who it is that is doing that, that's their problem. The people who really want to deliver social impact will find a way of doing it. And I think we've seen that, and you know, I'm not wanting to talk too much for Cis Ventures, because, you know, but we've seen brilliant social impact coming out, and it doesn't matter whether it's a private business or not. This is the point. So I just think, so my view is they will find their way eventually. They will find the route that's right for them eventually. And there are lots of people coming through the more traditional asset locked way. The thing that I see that I'm more worried about, and this is controversial, is the bad advice that some people are getting. So quite often I will end up being asked to speak to somebody who's been round the houses getting advice, has maybe set something up, and when you actually look at their why and their business model, they've set the wrong thing up. And my colleague Karen Anderson, who works with me in Homes for Good and also works at Cambridge, finds this all the time as well. They have been given the wrong advice, and if if you want to be social, you have to do it this way, and it actually doesn't fit their model. So yeah, I don't really care. I mean, I've never really cared about the structure of it. I think it's a limiting factor, the structure of it. It's about delivering the impact, and the really good, determined entrepreneurs will find the right way.
No, thank you, Susan. And I think, you know, the advice question is really important, particularly that early stage in terms of setting people up in a way that actually doesn't trip them up in the future. Is, you know, some things can be changed and some things are harder to change as you go down the route. So I think it's really understanding that advice. Alastair, you've been quiet for a while, so come on in.
I was going to say I agree with Susan, but no, I mean, all I would say on that point in particular is I think that we just need to reflect on the perhaps unique opportunity that exists around about our sector, particularly on the back of during the pandemic and the things that has exposed. We have entrepreneurs, particularly young entrepreneurs, who burn for purpose. We've got an investment landscape that is now acknowledging not just ESG, but purpose and impact in a way that never has before, and wants to make investments that make a positive social and environmental impact. We've got consumers in the street who want to buy products and services from local businesses and that are produced ethically and sustainably and not made in, you know, garment factories in Pakistan where people are paid, you know, a pittance. You know, there's a real interest in supply chains. And we've got corporates who are thinking more about their role in the world. So, you know, the conditions that exist around about our social enterprise sector, which, you know, I've been here for a while, you know, before it was quite discreet and bespoke and contained. People want to know what we are doing, and it's our responsibility as a sector to think about how we lift up our eyes and engage with the people that now want to know more about what it is that we are doing and taking advantage of that. And if that's an individual investor that is used to making EIS investments and getting 30% tax relief, then I would rather they put their money into something that was a social enterprise and get some impact as well, rather than just putting it into an EIS business, because that EIS business is the one where the entrepreneurs want to exit to make millions of pounds. That's what motivates them to a certain extent. On our side, we're interested in making an impact. So I think we just need to stop talking amongst ourselves, get our eyes up onto their highs and think about how we can engage with our wider world to make a better impact and to help make an impact in Scotland.
Couldn't agree more. Couldn't agree more. I think we talk to ourselves a lot and we need to talk to other people. I think and I have to say, I've been hearing that for a number of years, and we're still talking to ourselves. So again, it's that, what do we need to do that's different, that actually brings that conversation forwards. I'm conscious of just bringing everything to a close. Now, there is one question that was quite complex that was posted in the chat that I didn't know if you'd seen, and if someone wanted to just come in on.
I saw that, and I'm
the question as well as the answer.
I'm not sure of the answer, Naomi, but I'd be willing, if we were able to find out who the person is asking the question, which I'm sure you'll be able to either into Mel or myself, then I'm sure we could find an answer to that question. I suspect that you have to do a separate raise, but I wouldn't want to give the wrong information in public.
Yes. So it was a very detailed question for people out there, just in terms of debt and social investment tax return, in terms of timelines and when it comes in and when it can be included, which is why I didn't bring it to the session, because it's quite complex, but we'll try and pick up on that. Thank you, Alastair. Mel?
Yeah, and happy to help to answer that afterwards. And I suppose I was just going to build on Alastair and Susan just to bring mine to a close, which is just to say that, you know, it is about having a full range or spectrum of products. You know, Scotland is in a good position, and you know, we need to make sure that every product, and that's why we just didn't want to let social investment tax relief go. And it is really important that whether you're the individual investor on the street, so that you're doing that through a community share, or you're a sophisticated or high net worth investor who wants to get more impact, and whether you want to do that directly or indirectly, I'm up for any tool that allows us to channel that money towards impact. And that's why I think we've got to try and make the most of social investment tax relief.
Thank you, Mel. A strong point to finish on. Susan, just a final point from you. If you have one, I'm sure you will.
I don't actually.
Oh,
I think everything's been said.
I mean, what I've taken from this session is we need to do more to raise the profile of social investment tax relief. We need to, I think there's that call that needs to get looked at in terms of making sure that we give people the right advice around finance. I guess that Susan's made and Alastair was asking. And I'm always interested if there's more people in the session that think about that. And I guess it's getting the word out there that this is a possibility, and maybe we need to start talking about social investment tax relief, but not calling our sessions a session on social investment tax relief, to get people along, thinking back to what Mel was saying at the start. So I know that this will be a session that's of interest to people moving forwards, and we will certainly point them towards it if they come to us with any social investment tax relief queries. I just wanted to say a big thank you to everyone for joining us today. Really useful session, and really pleased that we got social investment tax relief saved. Let's make sure that we see if we can get it used more appropriately, work on that kind of naughty list changing in the next few years, and hopefully get more of that investment happening in the future. So thank you to everyone for joining us, and have a great day. Thank you, everyone.